Someone's sitting in the shade today because someone planted a tree a long time ago. This famous quote by Warren Buffett not only encapsulates his long-term investment philosophy, but also serves as a guiding principle for building sustainable wealth. As you approach or enter retirement, perhaps around 2025, his principles of money management and personal finance remain just as valuable. Applying these insights can help you secure a prosperous and comfortable life even without a primary source of income. Rule 1. Investing in yourself is the most important investment. Among the countless pieces of advice on investing and wealth accumulation, Warren Buffett has always affirmed a timeless truth. The best investment you can make is an investment in yourself. This principle is not only a guiding light for young people on their career development path, but also holds a particularly profound meaning for those who are entering or already enjoying retirement, perhaps with specific plans for 2025 and beyond. This isn't about pouring more money into a stock portfolio or a mutual fund, but rather the continuous cultivation of an intangible yet priceless asset, yourself, an asset that no market fluctuation or tax policy change can diminish. Investing in yourself means investing in expanding your knowledge and honing your skills. In a constantly changing world, continuous learning helps you adapt, especially when you have retired. For Americans nearing retirement age, updating technological knowledge is not only practical for effective personal finance management, such as tracking investments or making online payments, but also an excellent means to connect with family and explore new hobbies. The joy derived from online courses in photography or learning a new language for a dream trip is entirely within reach. More importantly, enhancing financial literacy helps you protect the assets you have built. In retirement, when income decreases, understanding safe investments, financial products, and recognizing scams acts as a shield for your wealth. Warren Buffett himself once took a Dale Carnegie course to improve his communication skills, a testament to the fact that learning skills always brings great value, helping you become more confident in social interactions and even enabling you to pass on your valuable experiences, leaving a meaningful legacy. Alongside knowledge and skills, health, both physical and mental, is an essential component of investing in yourself. Warren Buffett, despite his particular culinary preferences, remained sharp and active well into his 90s, demonstrating the importance of vitality. In retirement, good health is truly golden, allowing you the freedom to pursue passions, undertake cherished trips, and fully enjoy precious time with loved ones. An active lifestyle, proper nutrition, and regular health checkups help you live healthily and reduce medical expenses, a smart financial strategy in the U.S. Mental health is also important. Keeping your mind active through intellectual and social activities helps make retirement life meaningful and rich in experiences. A clear and optimistic mind not only helps you fully enjoy life every day, but also serves as a solid foundation for making sound personal finance decisions, protecting your life savings, and avoiding emotional investment choices with unnecessary potential risks. So why is investing in yourself even more important when you are approaching or already in retirement? Because this is when you have the time and freedom to care for yourself after many years of dedication. New knowledge enriches your spiritual life and can even open opportunities to generate side income, increasing your cash flow. Good health is the prerequisite for enjoying the wealth you have built, making every day a memorable experience. Investing in yourself at this stage is not an expense, but a wise and necessary preparation. This is how you proactively ensure that the golden years of retirement will truly be the best time, filled with joy, discoveries, and above all, complete financial peace of mind and independence. Rule 2. Prioritize saving and live below your means. Do not save what is left after spending, but spend what is left after saving. This timeless advice from Warren Buffett is the guiding principle for the second rule, an essential pillar for building wealth and ensuring financial security, especially as you prepare for or have entered retirement. This is not just a common money management method, but a philosophy of life, an adjustment in the approach to personal finance that helps you master your cash flow. Applying this principle means you determine your financial future, creating a shield against instability, especially when income is no longer stable. This is not just a common money management method, but a philosophy of life, an adjustment in the approach to personal finance that helps you master your cash flow. Applying this principle means you determine your financial future, creating a shield against instability, especially when income is no longer stable. The core of this rule is to reverse the order of priorities. Instead of considering savings as the surplus after all spending, you proactively set aside a portion of your income, from pensions, Social Security, or investments, to accumulate first. The remainder is then allocated to other needs. Living below your means does not mean excessive frugality or giving up all joys, but rather a conscious choice between essential needs and fleeting desires. Warren Buffett himself, despite possessing immense wealth, is known for his modest lifestyle. This moderation creates a significant surplus, not only to cope with unexpected expenses, but also as capital for new investment opportunities, helping your assets continue to grow. For Americans at or near retirement age, perhaps with plans for 2025, living below your means holds crucial significance. When the primary income source comes from funds like 401ks, IRAs, or Social Security, overspending can quickly deplete accumulated savings. Adhering to this rule helps manage cash flow effectively, ensuring that withdrawals from retirement accounts are sustainable, sufficient for a long and comfortable life. This requires meticulous budgeting, clearly distinguishing between needs and wants, and sometimes seeking more economical alternatives for entertainment or shopping while still maintaining quality of life. The practice of prioritizing savings can start with small actions, such as setting up automatic transfers of a fixed portion of income to a savings account as soon as it is received. Regularly tracking expenses through personal finance management apps or a notebook helps identify wasteful spending. The goal is not to live in deprivation, but to achieve financial peace of mind. Knowing you have a secure emergency fund and that your retirement fund is wisely managed will bring great tranquility. Wealth at this stage is not just about the amount of money you possess, but also the freedom from financial worries, allowing you to truly enjoy your retirement. Prioritizing saving and living below your means is a smart financial strategy, proven effective by Warren Buffett. It does not require complex skills, but rather discipline. By proactively controlling spending and putting saving first, you are building a solid foundation for a comfortable retirement, rich in experiences and free from money worries. Rule 3. Stay away from bad debt, especially high-interest debt. Warren Buffett once warned, "If you buy things you do not need, you will soon have to sell things you need." This advice is particularly poignant when it comes to debt, and it is the foundation for the third rule: stay away from bad debt, especially debts with exorbitant interest rates. For those who are preparing to enter retirement or are already enjoying their golden years, understanding and applying this rule is not only a wise financial strategy, but also the key to protecting the wealth painstakingly built up, ensuring a comfortable life free from the burden of money worries. Bad debt, in Buffett's philosophy and personal finance reality, often refers to consumer loans with sky-high interest rates, such as credit card debt, payday loans, or unnecessary installment purchase loans. These are financial traps that can quickly erode your savings and retirement income. High interest rates act like a form of reverse compound interest, causing the initial debt to swell rapidly, turning small items into enormous financial burdens. When you are retired, your income is often fixed and may decrease. Having to allocate a significant portion of your monthly cash to pay interest on bad debts will severely diminish your quality of life and financial security. Conversely, avoiding or proactively eliminating bad debt frees up significant financial resources.
The money that would have been used to pay interest and principal can now be used for essential needs, recreational activities, health care, or even small, safe investment opportunities to increase passive income. Being debt-free or only having manageable debts with low interest rates, for example, a small portion of a mortgage that is nearly paid off, provides invaluable freedom and peace of mind. You will not face the constant pressure of finding money to pay debts, especially when unexpected medical expenses arise, a reality not uncommon in retirement in the U.S. For those nearing retirement, making a detailed plan to pay off all high-interest debts before officially stopping work is a top priority. Consider temporarily tightening your spending or using some cash from bonuses or savings to clean up your personal balance sheet. If you are already retired and still carry bad debt, seek ways to restructure the debt. Look for financial counseling programs or consider options to transfer the debt to instruments with lower interest rates if possible. Most importantly, stop creating new unnecessary debt. Every spending decision should be carefully considered, avoiding the temptation of shopping with borrowed money. Controlling debt not only helps you preserve your wealth, but is also a step to true financial freedom in your golden years. When you are no longer shackled by debt, you have full discretion over how to use your money, enjoying the fruits of your lifelong labor to the fullest. This is one of the most solid foundations for building a secure retirement, rich in experiences and peace of mind.
Rule 4. Invest for the long term and be patient. Our favorite holding period is forever. One of Warren Buffett's defining investment philosophies is the core of the fourth rule: long-term investing and patience. Instead of trying to time the market or get caught up in daily news that causes short-term price fluctuations, a game where even experts often fail, Buffett advises us to focus on selecting companies with strong business fundamentals, sustainable competitive advantages, and holding those investments for a long time. Trying to time the market is a trap, especially dangerous when you no longer have an active income source to cover losses. This steadfast holding allows the magical power of compound interest, which Einstein once called the eighth wonder of the world, to work its full effect, helping your money grow steadily and effectively over the years, creating true wealth. For Americans who have entered or are approaching retirement age, maintaining a long-term investment horizon remains essentially valuable. Although the investment portfolio may need adjustments to better suit the need for stable cash flow generation or risk mitigation through less volatile assets like bonds or high dividend stocks, the nature of patience and discipline remains unchanged. Retirement today can last 2, 3 decades or even longer. Therefore, maintaining a steady mindset, not panic selling quality investments during temporary market corrections, is a key factor. History has shown that markets always recover after recessions. Hasty actions can lock in losses and severely deplete the capital needed for the long years ahead. Conversely, patience allows investments time to recover and continue to grow, protecting your assets from the erosion of inflation, an ever-present factor in personal financial planning. Wealth at this stage is not just about owning money, but also the ability to maintain a desired standard of living and peace of mind. Patience in investing, therefore, becomes a strategy for protecting and growing assets, helping your financial resources be robust enough to support a fulfilling, free, and less worrisome retirement. Rule 5. Invest in what you understand. One of the most fundamental principles in his investment philosophy: only invest in what you truly understand, also known as your circle of competence. Adhering to this rule is not just advice, but an imperative to protect accumulated funds and maintain wealth. This is a smart risk management strategy, helping you avoid emotional investment decisions or those based on unsubstantiated tips, which is especially dangerous when a stable income from work is no longer available. The circle of competence includes industries, companies, or types of investments where you have in-depth knowledge, practical experience, or at least the ability to analyze and evaluate independently. This could be a field you've worked in for many years, products or services you regularly use and understand how they generate revenue, or simple, transparent business models. Warren Buffett is famous for avoiding high-tech stocks for many years during their initial boom, not because he doubted their potential, but because he felt they were outside his circle of competence. This caution helped him avoid heavy losses when the dot-com bubble burst in the early 2000s. The lesson here is you don't need to be an expert in every field to succeed in investing. You just need to clearly know what you know and what you don't know. Once retired, capital preservation becomes the top priority. You no longer have much time or opportunity to recover from significant losses due to bad investment decisions. Therefore, investing cash only in things you truly understand becomes extremely important. Instead of chasing hyped hot stocks or complex financial products that even experts find difficult to explain thoroughly, focus on businesses with a stable operating history, a healthy balance sheet, and an easy-to-understand business model. These could be essential consumer goods companies, utility service providers, or businesses in the healthcare sector with which you have some familiarity. Thorough research, reading annual reports, and understanding a company's competitive advantages and long-term prospects are indispensable steps before making an investment decision. Peace of mind regarding personal finances is priceless. When you invest in what you understand, you will feel more confident in your decisions, be less swayed by short-term market fluctuations, and be able to sleep better at night. This contributes significantly to maintaining a life that is rich not only materially, but also spiritually. Limiting your investments to your area of understanding is not a restriction, but a smart discipline that helps you avoid unnecessary risks and protect the financial achievements you have worked hard for your entire life to attain, ensuring a safe and prosperous retirement future.
Rule 6. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This is perhaps one of Warren Buffett's most famous and frequently quoted statements, concisely and powerfully encapsulating the essence of his investment philosophy. This dual rule, rule number 1, never lose money, rule number 2, never forget rule number 1, is a core principle in all financial decisions. It is not only a path to protecting accumulated wealth, but also the foundation for a comfortable life, undisturbed by unnecessary financial risks. Understanding this correctly does not mean avoiding all forms of risky investments and only holding cash. Buffett himself is a stock investor. Its profound meaning is the paramount priority given to capital preservation. Once you lose a significant portion of your capital, earning it back requires a much larger rate of return. For example, if you lose 50% of your capital, you need to achieve 100% return on the remaining capital just to get back to your initial break-even point. A significant challenge, especially when you no longer have an active income from work to compensate. For retirees who depend on their accumulated capital to cover living expenses, losing money can have serious consequences, directly impacting their quality of life and long-term financial security. In the context of retirement, perhaps starting in 2025 or sooner, applying this rule means being extremely cautious and conducting thorough research before making any investment decisions. It requires focusing on high-quality assets, companies with solid fundamentals, sustainable competitive advantages, and trustworthy management. The concept of a margin of safety, buying an asset at a price significantly below its intrinsic value, becomes an effective tool for minimizing the risk of capital loss. This also means staying away from highly speculative investments, unrealistic promises of huge profits, or complex financial products that you do not fully understand. The temptation to try to get rich quickly can lead to costly mistakes, especially when you no longer have much time to recover. This rule emphasizes the importance of discipline and patience in personal financial management. It reminds us that protecting what we have is often more important than taking risks to achieve uncertain gains. When every spending or investment decision is considered through the lens of not losing money, you will tend to make wiser choices, more aligned with the goal of maintaining a stable retirement and richness in peace of mind. This is not just an investment rule. It is an attitude, a commitment to one's own financial security, ensuring that the golden years will not be overshadowed by regrets over careless financial decisions.
Rule 7. Keep a cash reserve and be ready for opportunities. Warren Buffett is not only famous for his wise stock investments, but also for his prudence in holding a significant amount of cash. The 7th rule, keeping a cash reserve and always being ready for opportunities, is a testament to this strategic vision. For Americans who are in retirement or preparing to enter this new chapter of life, understanding and applying this principle is particularly important, not only to deal with uncertainties, but also to seize opportunities that can help safely increase wealth. First and foremost, maintaining a cash reserve fund is the foundation of personal financial security, especially in retirement. Income at this stage is often more fixed and less likely to increase suddenly as it might have during one's working years. Therefore, a sufficiently large amount of cash, often recommended to be equivalent to 6 months to a year of living expenses or even more depending on individual circumstances and desired level of security, acts as a financial cushion. This fund helps you cover unforeseen sudden expenses, such as unexpected medical bills, a significant concern in the U.S., or urgent home repairs. More importantly, having cash on hand helps you avoid having to sell off long-term investments at unfavorable market times just to cover expenses, an action that can severely damage your financial plan and wealth. Besides its defensive role, cash also helps you capitalize on and seize opportunities quickly. During periods of high market volatility or decline, when many investors panic sell, the prices of high-quality assets can fall to attractive levels. This is precisely when cash reserves come into play. Even in retirement, if your financial situation allows and you still have a portion of your portfolio allocated for growth, being able to selectively deploy funds into good investment opportunities at bargain prices can bring significant long-term benefits. You don't need to research and trade all day, but rather be prepared to act wisely when real opportunities arise, helping your money have more potential to generate returns, contributing to a wealthier retirement. Of course, holding too much cash for extended periods also has the drawback of reducing the overall earning potential of your assets due to inflation. However, the purpose of this rule is not to hoard cash indefinitely, but to maintain a reasonable balance, enough to ensure safety and flexibility. For retirees, having cash available provides freedom, reduces financial stress, and allows you to make more informed decisions unswayed by financial pressure. It is an indispensable component in building a solid personal financial plan.
Warren Buffett's 7 money rules, from investing in yourself, prioritizing savings, avoiding bad debt, to long-term thinking, understanding your investments, not losing money, and keeping a cash reserve, are not complex formulas. They are fundamental personal finance principles requiring discipline and foresight. Regardless of what stage you are at in your retirement journey, applying these pieces of advice will help you protect and grow your wealth, aiming for a comfortable life, financial independence, and true richness in experiences.